There is one thing that could be killing your returns on your Trading 212 investment portfolio.
The dollar is going to struggle.
Forecasting 4% depreciation of the dollar.
2025, we think, will be a weak dollar year.
2 new countries have just ditched the US dollar. That is a huge problem.
The United States dollar is the world reserve currency, and it's also the currency that's used to buy popular shares in stocks like Nvidia, Tesla, Apple, Microsoft, Meta, Amazon, and Alphabet, some of which I own myself in my Trading 212 stocks and shares ISA. But despite these being some of the top performing investments over the past decade, if you use Great British pounds in order to purchase them, then your portfolio might not be so positive. FX rates are a major risk within any investment portfolio, and it's what we're going to discuss during today's video, because it's a risk that most investors don't even consider. Before we talk about some of the issues with the United States dollar and how that might impact some of the most popular investments being made right now on Trading 212, first let's talk about the relationship between investing and the foreign exchange market and how it all works. It's a fairly simple concept. Foreign exchange rates are simply just the value of one currency versus that of another, and they're depicted as currency pairs on the foreign exchange market. And these currencies fluctuate day by day. In actual fact, they fluctuate pretty much second by second, because the foreign exchange market is actually the most liquid market in the world, with about $7.5 trillion of traded volume every single day. That's roughly 7.5 times more than the equity market transactions on the New York Stock Exchange. But how do these rates become affected? And how can they impact us and our investment portfolios? Well, let's say that I had £10,000 which I wanted to invest in Apple shares. As Apple are a US listed company, obviously I have to buy those shares in United States dollars. And to complete this transaction, Trading 212 would convert my £10,000 into United States dollars, whilst also taking an FX fee of 0.15%, so the equivalent of 15 quid, which would be on this specific transaction, and then that would convert into roughly $13,114 worth of Apple stock, which, given that Apple shares currently trade at about $226 a share today, that would give me the equivalent of 57.8269689 shares. Now, as a side note, the shares that aren't whole shares are something called fractional shares, but that's probably another topic for another video. But whilst we are on the topic of shares, Trading 212 are kindly offering all of my subscribers one free share valued up to £100 when you open an account by clicking on the link down in the description below. Or alternatively, if you have opened an account with Trading 212 in the past 10 days, you can enter the promo code Mitch and just deposit £1 into your account and still claim that free share valued up to £100. But free shares to one side, once you've completed the purchase of those foreign shares, you then become exposed to the foreign exchange rate difference between that specific currency pairing, which in this case is the Great British Pound versus the United States dollar. But if I were to buy shares in, say, LVMH, it would be the euro versus the Great British Pound. Or if I were to buy shares in Toyota, it would be the Great British Pound versus the Japanese yen that I would need to pay close attention to. Now, the reason why I highlight that is because once you've been exposed to that exchange rate difference, actually the sole parameter for success isn't just seeing the value of a stock price go up, because now you have to consider what the FX rate is going to do to the value of that position. Because the second that you buy into foreign equity, you are relying on that foreign currency to at least maintain a stable value against that of your domestic currency, if not potentially even strengthen just a little bit to boost the gains on your overall portfolio. But let me unpack that in a little bit more detail and kind of share how it works. Going back to our Apple example, if we'd used Great British Pounds to buy United States dollars in order to buy the shares, we would need to then look at the currency pairing GBP USD to see how it changed in value over time. And on a longer term basis, it's been extremely volatile, especially post-financial crisis. In actual fact, the Great British Pound has lost some 37% of its value against the United States dollar during that period of time, which is great if you took the decision to invest in foreign stock, because the value of your portfolio would have been boosted up by 37%. But in most recent history, in the last 12 months, it's actually done quite the opposite. The Great British Pound has actually strengthened against the United States dollar to the tune of 8.4%, meaning as at most recent times, the FX rate impact on my investment portfolio has negatively affected the value of my portfolio and the investments that I've made to the tune of 8.4%. Or said in another way, if I'd invested 12 months ago into one single US foreign stock, I would have needed at least an 8.4% return on that investment just to get back to break even. And that would be because I've converted my stronger, more valuable Great British pounds into a weaker United States dollar. And this very transaction could very much be the difference between a winning or a losing investment portfolio over time. But how exactly has all of this affected my portfolio? Well, let's take a look at a little bit more of the details, because if I'm honest, it kind of does come down a little bit to just market timing and when I actually bought my investments. Just for context, I started investing on Trading 212 at the start of the 2020 tax year. And since that point in time, the United States dollar has lost about 5% of its value against that of the Great British pound. But because I've cost averaged my way into this portfolio over a duration of time, actually on some occasions the FX rate has been kind of favorable, and then on other occasions it's been unfavorable when we compare that to kind of point A at the time that I started investing versus point B, which would be today's market price. Now, in order to find out where this FX rate difference is within your own holdings on Trading 212, if you just click into one of the foreign stock investments that you own, scroll down ever so slightly, you'll be able to see under your returns tab, you can see the gain or loss in the valuation of the stock price, along with the FX impact too. But you can see I'm currently down £45.94, the equivalent to 1.68%. If I were to add up all of the unrealized profits and losses just on the FX rate difference alone, I would actually have seen a net unrealized loss on my account of £12.46. Now, partially one of the reasons for this is because of all of the economic and geopolitical uncertainty that's been taking place. And as a result, it could mean that the United States dollar continues to crash down in value, which could have some major adverse impacts on my investment portfolio. The United States dollar is the world reserve currency. It's an economic and political status that helps retain the value of the dollar. But why, you may ask? Well, it's because it creates stability. The only way that international trade can take place seamlessly is if there is one common value that every country agrees on. Going back to about World War II, there was something called the Bretton Woods Agreement, where 44 different countries agreed to peg their currency against the United States dollar. And as global trade grew, so did the use of the United States dollar to conduct the world's business. But with such widespread use of the United States dollar also comes power and control, because the US government can essentially place sanctions on countries to cut off their access to the US currency, essentially limiting their ability to engage in international trade and ultimately hurting their economy, which quite frankly has pissed some countries off. So some countries decided to form their own alliance.
Brazil, Russia, India, China, and South Africa. The BRICS is trying to position itself as the voice for emerging economies and challenge Western dominance of global affairs.
And as part of this new group that's formed, the BRICS countries are now looking to establish their own kind of reserve currency, which potentially may be backed by a basket of their respective currencies, moving away from that of the United States dollar. Now, whilst the impact of all of this is kind of unknown, if the BRICS countries did kind of establish what that new reserve currency is that they were going to use, it could certainly reduce the significance of US sanctions and the impact of US sanctions, and potentially also result in a further decline of the dollar's value. And we have already seen some countries moving away from the dollar, actually seeing the erosion of global reserves being held in dollars over the past 20 years. It's even led some to even claiming that there could be a de-dollarization, being absolutely unstoppable. Now, a continuation of this trend could mean an adverse impact for the value of my US foreign stock if the Great British pound maintains a stable value, whilst the US dollar continues to decline. Now, the reason why I've touched upon this is because this is just one of the many macroeconomic factors that could affect currency risk within an investment portfolio. Now, there are many other different factors to consider, some which include interest rates, inflation, unemployment rates, economic growth rates, and economic superiority, all of which may sound like a little bit of an unknown. So now we're going to explore some risk mitigation strategies that you could potentially look to deploy. There are a few different things that you could do to remove currency risk from your portfolio. So let's start with the first one, which is to hedge. To hedge the risk against the currency which is devaluing, you need to invest into something that's typically got a store of value. Now, one of the core characteristics of an asset that has stable value is scarcity, which is why gold is a popular asset to invest in, especially during volatile market conditions. In actual fact, the price of gold has rocketed in the past 12 months by about 45%. Thanks to all of the geopolitical and economic uncertainty all around the world. In my opinion, this is a clear indication of a flight to safety in these kind of circumstances, which is kind of a super important decision for all investors out there. The second strategy is to diversify internationally, because naturally currency markets kind of ebb and flow. Sometimes a currency can be really strong, and then on other occasions it can be weak. So the way to kind of combat this is to diversify, I guess, your investment portfolio to be exposed to all kinds of different currencies by investing in different foreign stock all around the world. It just may mean that you might have a handful of European stocks, a handful of Chinese stocks, a handful of Japanese stocks, and a handful of US stocks, with these four currencies being the ones that are held most in global exchange reserves. The final option is just to avoid foreign stocks altogether. The only way to completely mitigate this risk from your investment portfolio is to only invest in assets that are denominated in your domestic currency. So for me, that would be to simply just buy UK stocks, UK property, UK bonds, and settle all of those transactions in UK pounds. The only downside to this is that I would be significantly less diversified and potentially would have massively underperformed in the past 20 years too, with the US stock market strongly outperforming UK stocks, even once considering that kind of FX rate risk that's present. But these strategies, along with a few others which are out there, are all kind of for you to consider to make your own investment decisions based on your own risk appetite, investment objectives, and your investment time horizon as well. Now, if you do want to know how I'm potentially looking to tackle this within my own investment portfolio, well, be sure to subscribe to the channel so you stay up to date with all my future portfolio updates. And whilst we're on the topic of how I'm investing, I recently made a video actually sharing my past 8 years worth of experience in the stock market, building out my portfolio from absolutely nothing to £175,000. So if you do want to check out that video next, be sure to click here. With that being said, see you over in the next one.